Topic 3, capital gains tax. In this topic, we're going to look at the treatment of the sales of assets before September 1985, and then in relation to the new capital gains tax legislation, we'll be looking at the calculation of the cost base, how we calculate a gain, discount gains for assets sold after September 1999, and then at the end, how do we choose the best way of calculating our net gain? We'll also look at exemptions from capital gains tax. Capital gains tax history. Prior to September 1985, there was no such thing as capital gains tax. What happened was we had a section called 1515, which is now section 1515, and basically what it did was it taxed the profit from an undertaking or venture which was entered into with the intention of profit making by sale. So if, for example, somebody bought a block of land because they knew the area was going to be rezoned and they thought, we'll buy it now, when it's rezoned, we'll be able to sell it for a lot more money, that profit on sale was assessable as ordinary income. However, if it wasn't bought with that intention, so if somebody bought a rental property with the idea of renting it out, then if it was sold some years later, the profit was not assessable. You can imagine, of course, that it was in some cases fairly easy to get around 1515 by simply saying that you bought an asset with the intention of holding it long term to rent out or to earn dividend income or something like that. So it was necessary to change the law. So if we look at assets which were acquired before the 20th of September 1985, the only time the profit will be assessable is if they were bought with the intention of selling at a profit. So if someone bought a business or started a business and then sold it, that profit was not assessable because it wasn't bought or started with the idea of selling it at a profit. It was bought to run the business and earn income. So that's the first thing you need to remember. While we're not going to see as much of that because we've moved away so far now from 1985, you still do get people turning up, particularly you'll see it with land, where people bought large tracts of land in expectation of rezoning. And certainly some of that rezoning is now starting to come through. And you have to decide how to treat that. So we have an example that someone bought land in June 1985 with the intention of subdividing and selling it at a profit. The land was eventually subdivided and sold in January of the current year, and a profit of $100,000 was made. Now, that $100,000 profit is just straight income. It is not a capital gain. That is important because if it was a capital gain, we would be able to offset a capital loss against it. So please note, pre-September 85, it is not covered by the capital gains tax legislation. So we now have the new capital gains tax legislation. It sits within the Income Tax Assessment Act 1997. And what we do is we work out a net capital gain and then it just becomes a statutory item of assessable income. So even though we call it capital gains tax, it's not actually a separate tax. The amount of your capital gain goes into your assessable income, and as we know from topic 1, you take off your deductions and then you work out your tax payable. So it's not actually a separate tax, even though everybody calls it CGT, capital gains tax. Now, the government learned from its earlier mistakes, or not mistakes, but the shortcomings of the earlier legislation. And what we now have is the fact that if you have a disposal of an asset, you have a potential capital gain or capital loss. If you have a lease premium paid, you have a capital gain. And we'll look at that a bit later. So what we have now is if a CGT event occurs, then you have a potential capital gain or capital loss. Section 104 sets out all the different CGT events. It tells you when the event occurs and how to calculate a gain or a loss. Initially, when the legislation was first enacted, it was the gain above the inflation rate. That has now been frozen as at September 99, and a new discount method has applied since then, all of which, of course, we'll do as we go through this lecture. We basically calculate the current year's capital gains, the current year capital losses. We offset one against the other. If we still have gains, we bring forward any losses from an earlier year. And then if there's still a gain, then we pay tax on that gain. Once more, we're going to look at some specific terms, and it's really important you understand those terms and use them appropriately. I've just finished marking some exam papers for SUP and deferred exams. Now, here we're looking at students who've been through the whole unit and are still making some of these fundamental errors because they're not getting their terminology right, and so they don't quite understand everything. And then when we come to putting it all together in a large question, they make mistakes. So please understand our basic terms. So post September 99, the rules changed. We stopped indexing existing assets and we applied a discount method. Remember, capital losses can only be offset against capital gains. So it's really important to understand. Remember I said we just talked about 1515, that if you have an item of assessable income under 1515, it's just income. It's not a capital gain. The importance is if in the current year you sold 3 assets, one which was a pre-September 85 asset, so it was a pre-capital gains tax asset, and then 2 post-capital gains tax assets, one that was sold at a gain and one that was sold at a loss, that loss can only go against the capital gain. Now, if we've still got some loss left, we can't use it, we can't offset it against the 1515 profit because that is not a capital gain. So it's really important to understand you've got pre-capital gains tax assets. If they are sold at a profit, the profit is just assessable income. Then we look at the sale of an asset. Is it a CGT event? If it is, we have a capital gain. If it is, we might have a capital loss, and that loss can only go against CGT events, capital gains. So please understand that, because students really make mistakes with what is a CGT asset, what is a CGT event. And remember, capital losses can only be offset against capital gains. In section 100, subsection 15, we have an overview. And this is quite a good section to look at. So you should tag this section in your legislation. So we start off, you might want to open the section now so we can both be in the same spot. And it starts off by saying, do you have a CGT event? Because if there's no event, then nothing happens. Only when you have an event do the capital gains tax provisions start to apply. So the first thing is, do you have an event? Then the second question you ask yourself, if the answer is yes, do you have any exemptions? Because if it's exempt from capital gains, then you just put it to the side and you don't worry about the gain or the loss. If there is no exemption, do the proceeds exceed the cost? And if the answer is yes, then you have a capital gain. If the answer is no, you have a capital loss. So if we continue now into step 1, have you made a capital gain or a capital loss? Go to section 100, subsection 20, and what sort of things attract capital gains tax? And so we look at our capital gains tax events. Now, while some of the CGT events involve the sale of an asset or involve an asset, this isn't always the case. So there can actually be events where you get paid money not to do something, like a restrictive covenant. Now, we're not going into those events. We are going to look at 2 events. The first one is the sale of an asset, or in some way the disposal of an asset. The second relates to lease premiums. And those are the only 2 capital gains tax events that we're going to look at in this course. So what sort of assets are going to be covered? Things like land, holiday houses, buildings, shares, unit trusts, businesses are all the sorts of things we're going to cover. You can sell a house, you can sell a contractual right, you can sell goodwill. So the first thing we need to look at is there an exemption? What are exemptions? There are exempt assets and there are exempt receipts. Step 2, having decided we have no exemption and we have a taxable gain, we then need to look at what is a gain or a loss. So under section 100-35, you have a gain if your sale price, which they call capital proceeds, exceeds your cost base. If your sale price is less than the reduced cost base, then you have a capital loss. Now, later we're going to look at the definition of a cost base and a reduced cost base, and so you need to be familiar with those terms and what they encompass. And then step 3, calculate your net capital gain or loss. Now, the net gain or loss is what happens once you've worked out your gains and losses on all the assets you've sold in that year. If you've got more gains than losses, then you can bring forward losses from earlier years. If you have no losses, then you have a net capital gain. That amount goes into assessable income and is taxable. If, on the other hand, you've got more losses than gains, you have a net capital loss, and because capital losses can only be offset against capital gains, you stick with that loss. It stays with you until at some time in the future you have a capital gain and you can offset that loss against the gain. The loss is carried forward indefinitely until you make a gain at some future time. At this stage, you realise that that overview is very good, because at the end of the day, really one of 3 things happens. You have a gain, you have a loss, or you come to zero and nothing happens, or maybe what you've sold is exempt, so there's no gain and there's no loss. So be familiarise yourself with that overview. We now come to what I think is one of the most important sections that you really should tag and keep referring back to, because if you can't remember it when you're doing a question, if you come back to this section, it will make your life much easier because it sets out the steps that you follow. This is 102-5, and it tells you how you end up with your net gain or your net loss, and what do you do at the end of the day. And what it says is you take all the current year gains and offset them with the current year losses. If you still have a gain, then the next step is you bring forward your current year losses. Now, the interesting thing at both steps here, the Act says you choose the order in which you want to offset the loss. Now, what you want to try and do is get yourself into the lowest net capital gain so you pay as little tax as possible. You want to get the highest carry forward loss if you're in a loss position, because then you've got more losses to carry forward and offset against future income. And the Act says you make this choice. So the choice you're going to make is to minimise your income or maximise your loss. Now, this is going to take a little bit of thinking on your part, but once you've done a few of the examples, it will begin to make sense. The next step in 102-5 is that after you've applied all your losses, then you reduce by the discount method if you have any discount gains. This will make more sense to you a little bit later. So the most important thing out of this is losses are offset against gains first, and the discount is applied after that point. Many students make the mistake of applying the discount first and then offsetting the loss. You can't do that. 102.5 is very specific. Losses against gains, then discount. And then step 4 here says apply any small business concessions. And that gives you your remaining capital gain. So the first thing we need to look at is a CGT event, because if we look at section 102.20, it says you can only make a gain or a loss if a CGT event occurs. And the gain or the loss is made at the time of that event. Now, most events calculate the gain or the loss by comparing two figures. So basically your sale price with your cost base, or your sale price, which is called capital proceeds, with your reduced cost base. The difference will be your gain or loss. So when we look at our CGT events, because nothing happens until we have the event, what is the event is the first thing, what is the timing, and how much is the gain or the loss. The main CGT event we are going to look at is A1. CGT event A1. This is the main event that we are going to look at, and it covers the disposal of an asset. So it will be the sale of land, buildings, rental property, shares, or a business, as some examples. The timing of the event is when the contract is entered into. So when both parties agreed to the contract, the vendor and the purchaser have signed the documents agreeing that the sale is to take place. Now, what can be interesting, of course, is that the sale might take place on the 30th of June, but settlement for the land and buildings, or the settlement might not take place until July or August. Yet the capital gain arises at the 30th of June because it's the date that the contract is entered into, not when settlement occurs later on. So that's probably the most important thing to remember here. The capital gain is the difference between the capital proceeds from the disposal less the cost base. And the capital loss is the difference between the capital proceeds and the reduced cost base. Now, just to give you an example, if, for example, you sold an asset for $15,000 and you bought it for $10,000, then your capital gain is $5,000. So that's what it's saying. But if you sold it for $10,000 and the reduced cost base was $15,000, then you've made a capital loss of $5,000. So you can see now why our terminology is very important, because it sets us up as to which figures we're going to look at. What is a CGT asset? It's any kind of property. And it's a legal or equitable right that is not property. So it can cover things like land and buildings, shares, options, debts, and so on. So CGT event A1 is the sale and disposal of an asset. That's in section 108. In section 116, we have the definition of capital proceeds, and basically what we're looking at here is the sale price for our purposes at this stage. It can, of course, include things like the market value of property that if you've had an exchange or whatever, but we're not going to look at that. We're just going to look at a sale. So now you know that the capital gain is the difference between the sale price, the capital proceeds, and the cost base. So the most important thing is, what is this definition of a cost base? The cost base is defined in 110-25. Please have a look at this section as we work through this part of the I-lecture. The cost base consists of 5 elements. The first element is in 110-25(2), and it's basically what you paid to buy the asset. So the cost price of buying it. Of course, that's not the only cost associated with buying an asset. The second element are incidental costs of acquisition and sale, because you might have more costs involved in buying it or in selling it. Now, if you go down to 110-35, you'll see the definition of incidental expenses of acquisition and sale. Section 110-35, the incidental costs of acquisition and sale. The first of these is the cost of an accountant, a surveyor, a valuer, or somebody like that. As an example, if you're buying a business, you would take the accounts to your accountant to have a look at and advise you as to whether the business is worth the asking price. Any costs of transfer, if it's going to cost you to perhaps transfer the property from one place to another. Stamp duty, you pay stamp duty on land and buildings, and so that would be an element of your cost base. Costs of advertising and marketing to find a buyer or seller. So you might advertise to buy a property. You often see people saying wanted to buy a business up to this price, or advertising to sell, of course. Marketing costs. So you might want to perhaps enhance the property with some hired furniture if it was a rental property and the tenants had moved out. You often see properties like a vacant block of land or an old house that with a second story might have river or ocean views. The real estate people will often erect some scaffolding so people can climb up and see, well, if we had a second floor over here, these are the views that we would have. And that, of course, would allow you to ask a higher price when you're selling it. So all those sorts of things are elements of your incidental costs. And the cost of making any sort of valuation or apportionment. Search fees, if you wanted to search, you might want to look for properties in a particular area and then make an approach to the owners. Conveyancing kits or something similar. Now that would be if you didn't want to get a settlement agent to settle the property for you, you can buy a conveyancing kit and it tells you all the things you need to do to be able to settle the property yourself. And borrowing costs, the costs of borrowing money to be able to buy that property. Now, none of these costs will be deductible. None of these costs will be part of your cost base if you can deduct them. Now, this is an element that causes huge problems for students. This one and the next one, element 3. But think about it logically. If you pay an amount of money, you can only benefit tax-wise from that payment once. You can either deduct it against assessable income, or it will form part of your cost base, but you can't use it twice. So if we look at the borrowing costs here, if the property that you bought was a rental property, then over the term of the loan or 5 years, you would deduct the borrowing costs under section 2525, which we did in topic 2. If, however, the property you bought was your holiday house, then there is no income against which you would offset the borrowing costs. And therefore, when you come to sell the property, the borrowing costs would be part of your cost base. Similarly, if the property was, as you'll see in a minute with element 3, if it was your rental property, interest would be deducted against the rent, but if it was your holiday house, the interest would not be deductible and would form part of the cost base. So you need to start thinking a little bit here. What is this asset that I've sold? Was it used to earn assessable income? If it was, then, as you know, what we call revenue expenses, expenses that we incur over and over again, will be deducted against the income. If it was a non-income earning property, then these expenses will form part of our cost base. So let's go to element 3. So we've gone back to the cost base. So the cost base is the cost of buying it, incidental expenses of acquisition and sale, and now non-capital costs of borrowing. Non-capital costs of ownership. So remember back in topic 2 we talked about revenue expenses and capital expenses. Do you know the difference? Because now, here in capital gains tax, we're talking about non-capital expenses. In a minute, we're coming to element 4, and in element 4, we're going to look at capital expenses. So if you're not sure about the difference, go back into topic 2 and review the difference between capital expenses and ongoing revenue expenses. So here we're talking about non-capital costs of ownership. Be careful, this only applies to assets acquired after the 20th of August 1991. It includes things like interest on money to buy the asset. It includes insurance, the cost of maintaining, repairing or insuring the asset, rates and land tax, and interest on money you borrowed to refinance the loan. So you might have borrowed the money from one bank and then after a period of time you find you can get a better interest rate with another bank, so you change your loan. And if you've got interest or any refinancing costs, they would come into this element. So these are your ongoing expenses that you would incur. Now, once again, remember, if you can deduct them against your income, then they will not form part of your cost base. So basically, if it's a non-income earning asset, and the main sort of things here would be holiday houses, vacant blocks of land. There's no income arising from them, so these would form part of the cost base. But if it was an income earning asset, then if you think about it being your rental property, the rates and taxes, the interest would all be deductible under 8-1, and so they would not form part of the cost base. Element 4, are capital expenses to increase the value of the asset. Now, this element would include things like your initial repairs on a rental property. You may want to go back and review the concept of initial repairs. If they're ongoing repairs, they would fall into element 3. But if they're capital repairs, they would fall into element 4. This would also be something like perhaps a block of land, a rental property, and perhaps after a number of years you might redo the kitchen or put in a new laundry room or have the whole house, the whole roof redone. They would be capital repairs and they would fall into element 4. They're capital. Remember, capital gives you a long-term advantage. The repairs that we have in element 3 give you a very short-term advantage. So you paint the rooms and then after a few years you have to repaint the rooms. So that's an ongoing repair. These are capital repairs. The last element is element 5, capital expenditure to establish, preserve or defend title to your asset. So it may be that you bought your rental property and a week later the person next door comes over and says, oh, your fence is in the wrong spot, it should be 2 metres into your property. And so, of course, you're going to lose 2 metres all the way along your property line. So your property is now smaller. And so you may have to take some measures to establish where is the correct boundary for that block of land. That would be an element 5. Again, it's a capital element. So the capital gain is the difference between your sale price and your cost base. Your capital loss is the difference between your capital proceeds, your sale price, and your reduced cost base. When we first had capital gains, the capital gain was the difference between the sale price and the indexed cost base. That is, the cost base increased to take into account the effect that inflation had on that asset. Now, if you think about it, you might have bought a block of land for $100,000 and sold it for $150,000. You say, oh, great, I've made a $50,000 capital gain. But you may not have made a $50,000 capital gain. What this is saying is simply because of inflation, that $100,000 block of land was actually worth $120,000. So your capital gain is the difference between the indexed cost base and the sale price. So it's actually only a $30,000 capital gain. So what we need to do for these assets acquired before September 99, we need to be able to work out how to index our cost base. Now remember, we were very specific in talking about element 1, 2, 3, 4 and 5. And one of the reasons is we cannot index element 3. We can index the other 4 elements. So it's important to know which element your particular expense fell into. So we're going to look at section 114, and it says, in working out the cost base of a CGT asset acquired at or before 11:45 a.m. Eastern Standard Time on the 21st of September 99, you index expenditure incurred at or before that time for each element. So you take each element separately, so the cost of the asset, and you index that. And then you take the cost of perhaps an initial repair, which might have been incurred in 6 months after buying it, and you index that, and so on as we go through. So we've got an example here. Peter purchases a building as an investment on the 1st of January 94 for $250,000. The amount forms the first element of the cost base, and then he sells it on the 1st of February 96. The index number for the quarter he sold it, which is the March 96 quarter, is 119. The index number for the quarter in which he purchased it is 110.4. And as a result, using section 960-275, our index factor is 1.078. And so the indexed element of the cost base is 1.078 by 250 to give us 269,500. So only if we sold it for more than that would we have a capital gain. So let's have a look at indexing an asset. Indexing is simply saying what was the effect that inflation had on this particular element. Now the Act is very specific about how to index the cost base. We go to section 960-275 and it tells us how to do it. Now, because we are looking at selling assets in the current year and indexation was frozen in September 99, we use the index number for September 99. So if we look at 960-275 subsection 2, the index number is the index number for September 99, which is 123.4, divided by the index number for the quarter in which the expenditure was incurred. These tables are in the back of your unit guide, and they are also in the back of the Master Tax Guide. And you can take the Master Tax Guide into your exam, although we will also give you the index table in each exam paper, the mid-semester and the final. The index numbers are the CPI figures for each quarter. As you're aware, the CPI reflects what happened in that quarter. So if you bought an asset in April of 92, we will use the index number for June 92, because the June 92 in CPI figure reflects what happens in April, May and June of 1992. So if it happened in January, February and March, we use March. April, May, June, we use June. July, August, September, we use September. And October, November, December, we use the December number. Now, with indexation in 960-275 subsection 4, it specifically says you cannot index element 3. So it's particularly important to get your elements correct, because if they're in 1, 2, 4 and 5, we can index them up, which increases our cost base and reduces our capital gain. But if it's element 3, it's just whatever you paid. We don't index it for inflation. In subsection 5, it specifically tells you must index to 3 decimal places. So if the fourth number is 5 or above, we round up. If it's 4 or below, we just delete the rest of the numbers. So let's look at an example now. If we acquired a house on the 1st of January 89 for $10,000, we extend it in August 97, and we sell it for $20,000 in the current year. Can we index any of those elements? Yes, we can index elements 1, the cost and the extension. The cost is element 1, the extension is element 4. So therefore we can index both of them. Our capital proceeds are $20,000, and you'll see I've now done the calculation 123.4 divided by 92.9 and rounded to 3 decimal places to get 1.328, multiply it by 10,000, so my index cost is 13,280. I now index the extension 123.4 divided by 119.7, and I get 1.031 multiplied by the 2,000, and so I get 2,062. I add those two figures, and that is my indexed cost base. So 15,342 is my indexed cost base. So what we're saying is inflation drove that $12,000 cost up to 15,342. And therefore our capital gain is the difference between our sale price of 20 and our index cost base of 15,342. So because we have no other assets, we have a net capital gain of $4,658. You'll see from the next few examples, we're just comparing cost base and index cost base. So if you bought an asset for $10,000, its index cost base is 12,500, so I've already done the calculations for you, and you sell it for 13, what is the gain or loss on sale? Because you've sold it for more than the index cost base, there is a capital gain of $500. But if you bought it for 10, the index cost base was 14,500 and you sold it for 13,000, you have no gain and you have no loss. Now, one of the really important things you should write down and keep looking at is there are only 2 things that can happen. Well, actually there are 3, but there are 2 calculations you need to look at. A capital gain is where your sale price is greater than your indexed or your cost base, and your capital loss is where your capital proceeds are less than your reduced cost base. Now, if you don't fall into one of those, then you have no gain and no loss. And you can have a situation in which there is no gain but there is no loss. So you may have sold it for more than the cost base, more than you paid for it, but you may not have sold it for enough to have actually made a gain. But you haven't sold it for that little that you've made a loss. And we'll do some examples and you'll see that arise. Now, if you bought an asset for $10,000 and your reduced cost base was $9,000 and you sold it for $7,000, you've sold it for less than your reduced cost base, therefore you have a capital loss. So make sure you understand those terms. What is a reduced cost base? It's in 110-55 and it's basically our 5 elements, but we get rid of element 3. So once again, the categorization is important because if it's element 3 and we're looking at reduced cost base, all those things like interest and rates and taxes and repairs are taken out of the equation. So your loss may not be as great as you think it is. Also, you cannot index a loss. You only index a gain. And students say, well, how will I know? The first thing, of course, is to look at it and say, well, I bought it for 10 and I sold it for 15. You've probably made a gain. Now, not necessarily, because if you index it, it might be a lot higher, but the odds are you've made a gain. So you'd start off with looking at basically what did it cost you, what did you sell it for. If this looks like it's more, then you've probably made a gain. If, on the other hand, you can see you spent $100,000 to buy it, $10,000 on stamp duty, $30,000 on some expenses, and you've sold it for $120, then you know you've probably made a loss. But this will come to you with a bit of practice. But remember, you're learning in this unit how to look at legislation and apply it to specific problems. So you've got to look at it and get your mind thinking, yes, I think it's a gain, I think it's a loss. Oh, I thought it was a gain, but once I've added all these things in, I have no gain, but I haven't got a loss either. So you're really having to put the brain to work here. So remember, the capital gain is the gain above the inflation rate. The capital loss is the actual monetary loss. Only index a gain. Now here we have an example where we've bought a holiday house, we've paid stamp duty, we've renovated it, we've taken out a loan to acquire it, and we've paid stamp duty on the loan and interest over the term of the loan. We've got rates and taxes, and we've sold it for $105,000. We've paid commission on sale, and advertising was also paid. So stop now and calculate the cost base, and in doing so, work out each element. Don't just say, well, I think this is the cost base. Put everything into its particular element so that you know which one fits where. Now let's look at those elements. The acquisition, the stamp duty is an incidental expense. The renovation is a capital cost of maintenance. The stamp duty on the loan is an incidental cost. The interest is a non-capital cost, rates and taxes, non-capital, and commission on sale and advertising are all incidental sale expenses. And now you can go ahead and index it and work out the capital gain on the sale of that property. You can have a look at my answer, and you can see that we've started with the acquisition at 123.4 divided by 107.6, and I ended up with an index cost base of 97,335, giving me a capital gain of 7,665. If you didn't get this answer, you might like to post a question on the discussion board. And if somebody did get the answer, you might be able to help by showing your workings. How would your answer change if this was a rental property? Remember, you can only use the expense once. Once, either as a deduction against income or as part of the cost base. So it would be a good exercise to go through and work out the difference that it would make in your answer if it was a rental property. Now, we've learnt the mechanics of calculating the cost base, indexing the cost base, calculating the loss. What we now have to do is we have to sort of put them together and have a net gain or a net loss. So if we had a net gain, we include it in income. If we have a net loss, we carry it forward for future years. Remember, capital losses can only be offset against capital gains. So if we look at an example where a taxpayer sells an asset, selling an asset is a CGT event, and you make a capital gain of $15,000, the taxpayer is renting out another rental property or a rental property and makes a rental loss of $7,000. Now, because the capital gain goes into assessable income, and it's just another item of assessable income, remember we put all our assessable income together and we take off our expenses. We've made a loss from our rental property. We can offset that loss against our capital gain. Now, this doesn't mean that the rental loss is a capital loss. It's not. It's a rental loss. However, we have a net capital gain from the sale of that asset. Now, we might have had 5 assets that we sold and made a capital gain of $15,000. Okay? In the past, based on this example, in an exam question, when I've had a rental loss, students have put that rental loss in as a capital loss, but it's not. It means that perhaps the rent was $20,000 and the expenses were $30,000, and so we had $10,000. Oh, sorry, 7. The rent was $20,000 and the expenses were $27,000, giving us our rental loss of $7,000. It's not a capital loss. So please get that straight in your mind. It's a revenue loss, but because the capital gain becomes assessable income, we can offset those. So in this example, the capital gain is $8,000 because we can offset the rental loss against the capital gain. If, on the other hand, we looked at the reverse situation, let's look at the reverse situation where we have a capital loss of $15,000 from selling an asset, and we've got a rental profit of $7,000. What is the taxable income? The taxable income is the $7,000. The net capital loss has to wait until there's a capital gain against which to offset it. Now, having done all that, we've now worked out our basics. This part is actually really mechanical. Go into your 5 elements, index if need be, work out your gain or your loss, offset your losses against your gains, net gain goes into assessable income. One of the other hints I could give you is to keep your capital gain as a separate calculation so that you're putting all your gains and losses together, and then you come up with this net gain that slips into your assessable income. And that really reinforces it in your mind that you've done this separate calculation and your net gain becomes an item of assessable income. If you don't keep them separate, you tend to mix them up, and then you don't know where the discounts and things will go. So the main exemptions we're going to look at are exempting the private residence and trading stock and compensation amounts. Also, betting and gambling wins are exempt. So let's look at the exemption for your residence, which is the main one that we'll look at. If you sell your main residence, the house in which you live, the gain or the loss is ignored. That's one reason why a lot of people put a lot of money into their private residences, because if they sell it at a gain, they pay no tax on that gain. I've actually known of situations in which people buy a house, pretty awful house, live in it, do it up, and then sell it and make a profit. Because it's their home, because they've lived in it, they don't pay tax on it. then they've got a greater equity. They take that money, buy a not so good house in a slightly better area and do that one up as well, make a gain and move on from there. And in each case, they keep taking this exempt capital gain with them. And in the past, the Commissioner has tried to say, you know, it's a business or something like that, but hasn't been successful, usually because the people live in the houses for a fair period of time. So anyway, what do we mean? It's a unit of accommodation that is a building. It can also include a caravan, house, boat, mobile, not a mobile phone, as my notes say, a mobile home. And also land in the immediate vicinity of the accommodation. Now, there are a couple of alterations to that rule. Now, the first one is you can have a situation where someone lives in a house and then for some reason perhaps they get transferred. It stops being their home and they rent it out. Rather than leave it vacant, they rent it out. Now, there is an option in 118-145 to continue to treat that house as their main residence for a maximum period of 6 years. So you can live in the house, rent it out for 6 years, live in it again, or sell it at the end of the 6 years. But if you live in it for a period of time, then you can rent it out for another 6 years. So it may well be that you've actually owned the house for 15 years but rented it out for 12, because that's your maximum in those 2 periods. You can still have it as your main residence for that whole 15 years. So if you then sell it at a profit, you sell it at a gain, you don't have to pay capital gains tax. Now, this is particularly there to help people who've lived in it and then have to move out because they've been transferred with work. And then they might move back in. So each time you move back in, you can then use it to earn income for another 6 years. What do we mean by live in it? The Commissioner says it's having electricity, water connected, changing your address on the electoral roll, changing all your addresses for your bank statements. Everything now comes to this house. There is no specified time limit, but remember, if you did it all for a week and then moved out, the Commissioner may well say that you did it to obtain a tax benefit. So, perhaps 6 months or so. If you were going to be in that position, you would want to live in it and then keep documentation so you can show that, look, everything was changed. I joined the local library. Here's my library card, all that sort of thing, so you can prove that it really was your home for that period of time. Moving in with a sleeping bag and a camping stove probably doesn't qualify. Now, so we've got an example here. You sell your family home, make a gain of $11,000, and it's exempt. If you lived in it for 3 years and then rented it out for 2, you can still keep that residence. Now, if on the other hand, you lived in it, then moved out, you would normally pay capital gains tax on the time it wasn't your home. This is providing you don't want to use that earlier exemption. You would work out your capital gain on the basis of the number of days it wasn't your main residence over your total period of ownership. So we've got an example there. The other thing that can happen is you can be using it to live in and also using it as your place of work. Again, if 10% was used to earn assessable income, then 10% of the gain will be assessable. And the 90% that it was your home won't be an assessable capital gain. What we've covered to this point are the basics of capital gains tax. So we've identified our cost base, we know how to work out a gain, a loss, we know the exemptions that exist for the main residence. If you think about the main residence, it's really pretty simple. If you use it as your main residence, it's exempt. If you rent it out or use it to earn income, then a percentage of the gain will be assessable. You have the option, of course, of using the alternative whereby you can extend the period of exemption. Remember, of course, with that, you can't also then claim the exemption on another house, so you only get it for one house. And while we're talking about that section, I probably should have mentioned it earlier, if it was your main residence and then it stops being your main residence and now you're going to start using it to earn assessable income, you often find this where people buy their first home, build up a pretty good equity in it, and then decide that what they might do is buy another house in which to live, and they'll rent out that first house. So obviously they haven't kept, because it was their home, they haven't kept a lot of documents and things about capital costs and so on. So they have the option of they will use the market value at that date as the cost base. So instead of worrying about what you paid for it and all the rest of it, you get it valued at the date it becomes income earning, and that market value forms your cost base. So even if you bought it for 100, did some things with it, and then decided to use it as your main, to rent out, and at that stage the market value was 180,000, that becomes your cost base, and then if you sold it for 250, then you'd have $70,000 capital gain in the future. So once upon a time, we would have stopped there, and that would have been the end of capital gains. What we've now got is a change in legislation in 1999. Now, I had to tell you everything before that I've told you already. I had to tell you about indexation because it still continues. For any assets that were bought before the 21st of September 99, indexation continues to apply. And the taxpayer has the option of saying, which method would give me the better result? Will I be better off using indexation, or should I use this new discount method? So what you have to do is, for assets bought before that date, you still need to do indexation. You also need to look at what would be the result under the new discount method, and then decide which gives you the better net capital gain or the highest net capital loss. So in September 99, indexation was frozen. For assets bought after that date, and also for assets bought before that date, so they now have the two methods available, what happens is you calculate your gain, offset any losses, and then, if you're going to use the discount method, not the index method, the discount method, you only pay tax on 50% of the capital gain. Now, don't make the mistake of saying, well, my index gain is this, my discount gain is that. If I halve it, that's less than that. Because remember, you first offset the losses, then we apply the discount. So we do what we did in relation to the cost base. We add up all the elements of the cost base. We take it from the sale price. After offsetting any losses, if there are any losses, we then discount that by 50%. So what is a discount gain? This is defined for you in section 115. A discount gain is the gain that meets the requirements in subsection 10. It's an individual or trust, but note, not a company. It does not include a company. You get the gain. You can only get indexation or discount. You can't get both on the same asset. The beauty of this is, if you've sold a number of assets, you can use index for one, discount for another, so that you get the lowest net capital gain. But you can only have one for a particular asset. And you must hold the asset for more than 12 months. So if it's less than 12 months, you don't get the discount. So if you think about selling two assets, one was held for less than 12 months, one for more, and they both had a $10,000 gain, you'll pay tax on the full $10,000 gain. Let's say they're no losses, but only $5,000 on the one that you held for more than 12 months. Now, this is particularly important in a minute when we start looking at offsetting losses. We've got an example here where we're going to compare which would be better using indexation or discount, and you'll see that obviously in this example the discount method is better. But if I change the index cost base up to 8,500, then you'll see that the indexation method is better. Now, in this case, in that case, we had no losses, so it was quite easy to compare. It becomes difficult when we've got losses to take into account. If you'd like to go back now to example 2, where we sold the house, where we had we bought the house for 10, extended it for 2, sold it for 20, and previously we worked it out on the basis of indexation. Now we're going to use discount. You'll see that under the discount method, that gives us a better outcome. Again, there are no losses involved. Now, probably the hardest thing for students to come to grips with at this stage is deciding which is the best method to use. Should they use indexation? Should they use discount? And where should you offset a loss? Should you offset it against the index gain, the discount gain, the non-discounted gain? And there are actually no rules for this. The rule is you do it to obtain the lowest net capital gain or the highest capital loss to carry forward. So what you need to do is, first of all, just calculate your gains and losses for each asset. Don't decide, oh, I'll use the index here, I'll use the discount there. You don't make that decision until after you've done your calculations. So first of all, do your calculations. Then probably the only general rule would be, if you had an indexed gain or a non-discounted gain, an asset that you held for less than 12 months, if you've got a loss that's very similar in amount to that figure, offset it against that first. Also, because, you see, you want to get the most out of your discount. So you wouldn't want to have a fully assessable gain of, say, $5,000, and if you had a $5,000 loss, you wouldn't want to put your $5,000 loss against your discount gain and then leave your full gain to be assessed in total. So you have to play with it a little bit. One of the things I would suggest is please have a look at my setting out. You'll see in my setting out that on one line, but in 2 columns, I've managed to do, for each element of the cost base, I've managed to do the cost base and the index cost base. And then at the end, you've got your indexed gain or your discount gain. And it makes it much easier when you're comparing your figures to decide which one to use. So I can't give you a lot of help on that one. The best thing to do is to actually play with some figures. And you may even want to make up some figures of your own. So say, asset A, no discount, gain of X. Asset B, index gain, discount gain. Don't go through all the calculations, just put some rough figures in. And then in asset C, a loss. And then play with the figures. If I put the loss against the index amount, and then I've got the full gain, where do I go? If I put the loss against the discount amount, and then the full amount, where do I go? And see which gives you the lowest net capital gain. That's what you're trying to achieve. The last thing we need to look at now is the small business relief under section 152. In here, the Commissioner or the government wants to give concessional tax treatment to small businesses. You qualify for a small business if your net assets are $5 million, and the asset you've sold is actively used in your business. So this would be things like goodwill, land and buildings that you're using in your business. And it gives you a further 50% discount. So you can have, and I've got a little example for you here, where a business sells its goodwill for 75. It didn't pay for it. So it's 75,000 minus the general gain of 50, the active asset gain of 50. So we're only going to pay tax on 18,750. Now, if you're looking at offsetting losses, you would only want to offset your loss against your active assets last, because you get 2 discounts on them. So you don't want to lose those 2 discounts. So you would tend to go against your indexed gain, if that worked, or your non-discounted gain. Then you'd go to your discount gains, and then you'd go to your active assets. But it may be that even with offsetting the loss, you might still be better off with the discount gain. So I can't give you a real rule. You have to play with the figures. Lease premiums. These are CGT events F1, and it's simply where a taxpayer receives a premium when renting out a property. So before the property is rented out, the landlord says, you will pay me a lease premium of X amount. That amount is a capital gains tax event F1. Because it's a capital gains tax event, you can offset capital losses against it. And the cost base, of course, is any expenses incurred in setting up that lease premium. A lot of students forget this as an element of a capital gain, as a capital gain event. So don't forget that. And the importance is that it allows losses to be offset against it. Because it's not held for 12 months, there's no discounting available, and of course no index because it's happened in the current year. So we've now covered our 2 elements of our 2 CGT events, the disposal of an asset and a lease premium. So in summary, what we've done is we've worked out pre-capital gains tax assets, we've worked out CGT events A1 and F1, we've looked at our cost base with its 5 elements. We've looked at how to index a capital gain or the cost base to get our capital gain. We've looked at exemptions, and then we've looked at the discount method, which applied after September 99, and active asset concessions.